Hello everybody and welcome to today's webinar, Risk Aggregation and Visualization Naturally. My name is Colleen Lezovitz and I'm a Marketing Manager at Qlik, and I'm joined by my colleague Paul Van Sicklin, who is the Market Development Director for Financial Services. Also presenting today is Dilip Krishna from one of our partner organizations, Deloitte. Dilip is the Director of Deloitte & Touche's Audit and Enterprise Risk Services Advisory Practice. Before we begin, just some quick instructions regarding the webinar. As you can see, we are utilizing WebEx. All participants will be on mute throughout the entire presentation. However, if you do experience any technical difficulties, please utilize the Q&A window at the bottom right-hand corner. Please also use this window to submit questions pertaining to the topics presented at any time, because we will be holding a short Q&A session at the very end of the presentation. At this time, I would like to hand things over to Paul. Paul?
Hello, thank you, Colleen, for the introduction, and thank you everybody for joining our webinar today. My name is Paul Van Sicklin, and as mentioned, I'm the Market Development Lead for Financial Services in the Americas. And today's discussion is about QlikView risk and the integration of QlikView into a model that Dilip and his team have built for the stress testing process. And I'd also like to thank and welcome Dilip and thank him for participating. Thanks, Dilip, and we'll pick you up in a few minutes. Before we begin, this is our safe harbor statement, and we may have some forward-looking statements, and the safe harbor statement can be found on www.qlik.com, and you can read it at your convenience. There are two parts of today's webinar. The first one is I will cover an introduction to QlikView and Qlik in Financial Services, and then Dilip will review the recent results in a global risk management survey conducted by his team, followed by some excellent discussions around stress testing, modeling and analytics process, which they have built and have great expertise in. So, a little bit about QlikView and what our software is and what it does. Great things are happening with business discovery. Technology has finally caught up to the speed of business, and users are getting the data they need to make fact-based business decisions. QlikView is unlocking the power of information that used to be locked up on a few power users' desktops and making it available to the entire organization in near real time, providing them the ability to make real-time decisions. Development of transformational applications in QlikView takes days and weeks, not months and years. I've seen many examples in the industry of weekly project life cycles, from idea generation, proof of concept, to a fully integrated development, UAT, and production rollout to thousands of users. As important as it is to deliver meaningful and transformational data to our users, IT must retain control, and proper governance must be at the forefront. And with QlikView, it is. In fact, the data governance dashboard available on Qlik Market is one of the most downloaded apps on our Qlik Market site. Delivering a report only to have users export the data to offline non-compliant tools like spreadsheets has become commonplace, because traditional BI presents information in a static, rigid way with very limited ability to manage the real-life changes that occur in large organizations. QlikView users, on the other hand, have the freedom to explore their data, find new insights into their data, and collaborate with their fellow employees without the need to pull or push data outside the platform. QlikView users understand that the question's different every day. They don't have to go back to IT every time they need a new view of the same data. QlikView users exist in large numbers in the financial services industry. We have over 2,800 financial services companies, including all of the top 20 financial service firms in the US and EMEA, using our software. We not only have a growing employee base of 1,700 people, we also have an incredibly strong partner network who are extremely important to Qlik and our customer success. All the logos on this slide are actual publicly available case studies or press releases that are available on www.qlik.com. As we all know, data is treated like an asset in the financial services industry. QlikView is used many ways across a variety of businesses and functions, and our customers are greatly increasing the value of that asset, of that data. In this webinar, we're focused primarily on risk management and compliance. However, even in the demo you're about to see that Deloitte's put together, there are views that are finance related, portfolio management related, and even pertinent to executive management as well. And finally, before we hand off to Qlik at Deloitte and Touche, I just wanted to point out the Qlik ecosystem that exists. You can find more information on www.qlik.com/financial-services for our specific industry page in financial services, banking, insurance, and securities and investments. We have a financial services group in qlikcommunity.com. We have a financial services section in the demo site, and there are many Qlik Market apps built by our partners that are out there and all you have to do is search by banking, securities, investments, or insurance. So having said all that, I'm proud to welcome and pleased to welcome Qlik to the webinar. Qlik, I'm going to pass you the ball and hand it over to you.
Thank you, Paul, and welcome all to the webinar. I appreciate, along with Paul, appreciate everybody joining here and spending an hour of time looking through what we have done. Today, I'm going to talk about a topic that is very close to heart to many large financial institutions really around the world. A lot of the work that I do and my team does focuses on the U.S., but this is a practice of stress testing that has become a significant risk management tool for banks and regulators around the globe. So hopefully the folks on the phone would find a lot of this interesting. Before we get into the topic of stress testing, I did want to talk a little bit about the survey that Deloitte did a couple of years ago, a year and a half ago now. The risk management survey from Deloitte, it has been a fixture for many years. This is in its 8th edition right now, and it was done in the second half of 2012. Essentially, what we did was to talk to chief risk officers or their equivalent counterparts at a large number of financial institutions around the globe. As you can see, there were 86 institutions, so a good sampling across the globe. The kinds of institutions that we talked to were pretty varied, from commercial banks to insurance companies to asset management companies and so forth. The regional split was also quite extensive. There were, maybe even split between U.S. and Europe, and the size as well was quite varied. So the survey itself was a very wide-ranging and a good sample of risk management practices in financial institutions. To get more information about the survey, there is a link, and you can use that. The survey itself is quite an extensive document that is well worth the read. There are a number of topics that we cover in the survey, but just to focus on risk technology and data, there were a couple of interesting outcomes from the survey. The top issues that banks and other institutions reported were in the area of reporting frequency and timeliness, data quality, integration of data, and one of the interesting new items has to do with technology adaptability. In other words, how can risk technology react and work proactively to deliver capabilities that were not envisioned when they were put together? And this is becoming increasingly important as regulators are upping the ante in terms of what they expect financial institutions to deliver to them, and frankly, what they expect financial institutions to work what framework they expect financial institutions to use for risk management of the institutions themselves. And we'll talk a little bit about this going forward, that the adaptability of systems is an area of intense interest with many institutions. Not surprisingly, the priorities that people put on the go-forward approaches dealt with data quality and management, dashboarding, operational risk management systems, and risk analytics. And all these topics are things that we will touch upon today in the demos that we show. The diagram below deals with what you might think of as a typical go-forward architecture, something that most people look at aspirationally. Most banks would not have a situation quite as clean as this, of course, given that most institutions are large and complex and have grown over many years, both organically and through mergers and so forth. The systems landscape is typically a lot more complex than this, but this is where people are headed. And the areas that people focus on are data, of course, making sure that data is integrated appropriately and collected together and so forth. And then run through risk management engines, risk management models, if you will. But these are very complex, large systems implementations across literally geographic divides with many of the large global financial institutions. At the end of the day, the purpose of pulling the data together and running them through risk management systems is to provide reporting and analysis. And that becomes an increasingly important problem, something we'll talk about today and describe how, in one instance, it can be done. But reporting, analysis, and dissemination of information, both internal to the bank as well as externally to regulators and increasingly to the public as well, is becoming a topic of intense importance and interest within the financial community. So the next slide shows the stress testing and capital planning process. This is a very complex process and something that that banks have struggled to put forward and put together over the past several years. It's definitely not only technology. There are many other areas such as governance, dealing with response to regulators, dealing with interpretation of a bank's perspective on stress testing and risk management itself. The review in what is called independent review is an important aspect of stress testing, and I'll explain why and how a little bit later. But independent review causes a tremendous amount of increased participation from groups that you wouldn't normally expect to be part of a process within the bank. And of course, then you get to the actual infrastructural aspects, which have to do with collecting the information, running them through risk models of various kinds, data management, including data quality and so forth, become very, very important, and finally the reporting components. But these infrastructural aspects have to be surrounded, if you will, by a number of processes that have to do with governance, that have to do with senior management oversight and so forth. And without any of these components being in synchronicity with each other, without any of these components, if any of these components is less than what regulators expect the banks to have, that can cause problems in the stress test. Okay. So what is a stress test, and what does that whole process entail? Essentially, what we're trying to do in stress testing is to see what a bank's financial results look like in the situation of in a situation where the economy is facing significant challenges. And we've had a number of these situations over the past 20 or 30 years. Clearly, 2007 and 2008 was one of them, but you had numerous others. 1998 with the Russian situation, the Mexico situation, et cetera, caused a lot of destabilization. Of course, in different parts of the economy with different institutions. Certainly, and this has not only been focused on the U.S. Europe has had challenges. Asia has had challenges as well. And what regulators across the globe are trying to do is to understand what the bank's financial statements would look like in a situation where the economy is under stress. And the way we do this is to create what's known as an economic scenario. A scenario is, you can think of this as a combination of macroeconomic factors, things like a projection on unemployment, a projection on the GDP, gross domestic product, projection on home prices, on commercial real estate prices, on treasury bill rates, and so forth. The equity markets, what does the S&P 500 look like in a stressful situation? And here we are playing what-if games. So what a regulator is looking for, specifically now in the U.S., is a 9-quarter projection of these macroeconomic factors, and then a look for the bank to run their portfolios through the macroeconomic factors. In other words, the question is, for example, what does your credit card portfolio look like if it were to go through a cycle where unemployment were to rise to 12%? And clearly, if unemployment goes that high, one would expect that the holders of credit cards that have been extended credit by the bank, many of them would default, and as they default, losses would accrue on the portfolios itself, and those losses would impact the financials of the bank. The final number that the stress testing is looking to address is capital. It addresses a couple of other items such as leverage as well, and you'll see all of that in the demo. But a key number that is being looked at is capital, which is the ability of the bank to withstand the financial crisis. And at the end of the day, the regulators across the globe are looking to ensure that banks are not going to be putting themselves in a situation where they need to go back to the government to be bailed out, as they were in a few cases over the past years. So that's the overall perspective on stress testing. The logical architecture is shown at the bottom here. This is, I want to emphasize, is a very clean architecture in comparison to what most banks have, and it's very clean in comparison to what most banks have because of the diversity of the institutions and the fact that most institutions have their data in a very disparate sort of an environment. So typically, while you see here a single data mart, if you will, large institutions might have tens of data marts. They might have 20 or 30 or 50 of these aggregations of information, actually in some cases many more, and have individual risk models run against those individual sets of data. Finally, they all push them through a projections engine, and a lot of this in many large banks happens through Excel and other frameworks like that, other technologies which are probably less robust than they would like. But at the end of the day, the engine generates projections of financials. In the U.S., 9 quarters of projections are required, and those projections are analyzed by the institution very deeply. It goes through that entire governance process that I talked about earlier. And when the senior management and the board of the institution is comfortable that the projections accurately represent the status of their institution under cases of stress, these reports are actually sent to the regulator, and the regulator actually reviews those reports very carefully and makes decisions on those reports which would have significant impact to the banks themselves. For example, if the stress test is not satisfactory as per the regulator, they could ask the bank to stop issuing dividends, for example, or they could prevent banks from making acquisitions based on their capital position. So this has a very real and strategic impact to the bank if the stress test is not successful. So the analytics in stress testing, which is really the topic of today's conversation, is something that historically has taken somewhat of a backseat because of the challenges that banks have had in actually pulling the data together in the first place, but increasingly is becoming important. There are a number of reasons. I've called out a few here. One of the important ones has to do with improving the management understanding of stress test results. I explained a moment ago the very severe consequences a poor stress test could have on a bank's strategic position. So it's important that the management of the bank has a clear understanding of the results of stress tests themselves and how those stress tests are being presented to the regulators. More recently, in the U.S., the Federal Reserve and other regulators have issued documents and regulatory guidance that are specific on the kinds of stress testing and the kinds of practices that one needs to do. One of the key areas is called sensitivity analysis. And what sensitivity analysis entails is not only running a stress test on a given scenario, but asking the questions of what if the scenario were slightly worse than the one that was in fact used, and getting a good understanding of the behavior of the portfolio, not just at the scenario, but how the portfolio behaves as the scenario might get worse. And we'll show you some examples of how sensitivity analysis, in fact, has been built into the tool that we have for today's demo. But that's an example of where analytics becomes extremely important. Another example is reverse stress testing, and the concept there is to answer the question of what scenario is it going to take to break the bank. So clearly, the scenario would be hopefully far more severe than the scenario that is being used to report the capital. But let's try to understand how bad does it have to get in order to break the bank. And once you understand that, presumably the answer is going to be so far outside the possibilities that is another indication of the bank's safety and soundness. A very important concept in stress testing has to do with effective challenge. Since stress testing is all about projections, it's all about what if scenarios into the future, it's very easy to make up potentially rosy scenarios and assume that everything is okay. And what regulators are increasingly asking for is banks themselves to use some healthy skepticism in their own process. So they're challenging banks to internally ask very tough questions of the scenario. Is a risk model appropriate? Has the risk model truly taken into account all the situations that could, in fact, be damaging to the bank? Does the risk model behave appropriately when the situations become increasingly stressful? Those are the kinds of questions that are being asked. And the other questions have to do with the scenarios themselves. Is that scenario truly the worst scenario for the bank? For example, a certain bank that has a tremendous amount of retail product in a given geography would have a particular scenario that might be problematic. For example, home price indexes falling would be very damaging to a bank that is a big mortgage lender, but home price indexes falling may not have a huge impact on a bank that is largely in the capital markets and is dealing with instruments that have nothing to do with home prices. So the challenge process and on scenarios will in fact ask those questions about, are you truly doing a proper scenario, or is this scenario not representative of the bank in question? Finally, the whole process of analytics and bringing the data together has very important implications to the automation of stress testing itself. And stress testing automation can improve the performance and speed of the whole process, bringing it down from days and weeks to the matter of hours. It can improve control. So the question of whether the stress test actually represented proper data gets answered from that perspective as well. So automation is something that many banks are engaging in increasingly. Certainly in the U.S. that is true, and worldwide as well. So that's a trend that one would expect to continue as this whole process becomes ingrained as a risk management discipline within banks. So now I'd like to turn to the demo itself, and I'm going to invite Paul to join me in presenting the demo. We'll talk through a number of interesting areas of what we think is our exciting views of the data through the analytics. As we talk through it, please send through questions, as Colleen mentioned earlier, and we'd try to answer some of these questions as we go along. We can certainly hold those for the end of the call as well.
Great. So you can hit share. You got it. Perfect.
Okay. So this is the Qlik View application that we pulled together. The application, I should mention that I'm personally not a long-time Qlik View user, and frankly, I'm not as technical as one would expect. So hopefully this goes through without a hitch. But as with all demos, there's a disclaimer to start with. We actually pulled a lot of this together over the past 2 or 3 weeks. So you'll see it's a pretty nifty application the way it's all come together. The underlying information to this comes from an engine that we have built. Currently, we're not showing you the engine, but the information aggregation was a pretty significant effort itself. Aggregation of the information, pushing it through the models and so forth, a fairly significant effort. But the results are really what we're going to be showing today. Just to walk through how the app looks, you have 5 tabs, maybe 6 of them now. 6 tabs here, and each tab represents a certain aspect of the stress test. I'll talk about the various components in a moment, but the tabs are really broken down between looking at the overall financials of the bank. Those are the first 4 tabs, and then we wanted to show you what analytics on a single model looks like as well. Those, in this case, we're dealing with the commercial real estate model and the analytics that deal with looking at the data coming out of the model itself. The presentation on this screen has on the top left-hand corner over here, you have the various macroeconomic factors. We're dealing with things like mortgage rate. We've got the inflation rates. We've got unemployment. We've got the GDP. And what we're showing here are these spark lines which indicate the trend of the information over the 9-quarter period. So you can see here that GDP in this particular scenario, which is the Fed stress plus unemployment, 50 basis points. I'll explain that in a moment. But in that scenario, the GDP goes down first, and then it comes back. So what we're trying to measure is what happens in a case where GDP really takes an initial big hit, and then we want to see how the bank can come back as well as the economy improves. You'll see here that unemployment, though, has shot up, and then it sort of remains consistent across. We're showing here that unemployment on average is 11%, 11.2%, which for the U.S. is extremely high. The U.S. unemployment is hovering around the 7% range right now, so this is a significant stress. And so this panel shows the macroeconomic factors. Quickly to walk through some of the other panels, you have the capital ratio in the center panel here, and what we are doing here is to understand the capital strength of a given bank. There are some ratios that are important. So the first ratio is the total capital ratio that has to do with the overall capital, equity, preferred debt, etc. that the bank holds and can rely on in the case of stresses. Another important ratio is the Tier 1 capital ratio that takes out preferred capital and is a more conservative form of capital. This is truly capital that a bank will definitely have in case of stress situations. And an important another ratio is the leverage ratio. This talks not so much to the capital per se, but the leverage itself that the bank has got. How much is the bank borrowing versus the capital it's got? And the leverage ratio is extremely important because that was one of the factors that over several crises has been pointed out as an area as an indicator of the bank's strength or otherwise. So these are three ratios we show here. We're also showing a little dotted line here that indicates the minimum regulatory minimum capital that's required. So you'll see that line show up in other instances as well. The bottom panel just shows the value in dollars for this particular fictitious bank. The Tier 1 capital starts off at $11 billion and ends up at $8 billion. This is expected behavior in the case of a stress situation. You're expecting capital to get drawn down. What you don't want to see is capital to be drawn down below a certain minimum, which at that point would become regulatorily problematic. The top panel shows some average metrics. An interesting average metric here is the total net income, and you'll see that is a negative $2.6 billion in income. And it is negative because you're expecting in the stress situation that the net income is actually negative. Your banks are going to make a loss through that entire period. And what we're looking for is how negative is it, and how much is that negative net income eating into capital. So that's really the analysis that you're looking to do. On the right-hand side, this is now a drill down into the loan portfolios of the bank. What you see here are the losses by year. So you have, and I'll do it by quarter. It's a little bit more easier to see. You have the losses for each quarter being shown here, and then the cumulative loss as well. Of course, again, when we are looking at capital, the cumulative loss is what matters because that's the loss that ends up eating into the capital over the entire 9-quarter period. At the bottom, we're able to show different loans. Now, we're only showing the commercial real estate space here, but it breaks into different business groups. We can look at other cuts of it. We can look at the business divisions. And you can see that most of the loans are in the portfolio division, but the commercial lending has a significant portfolio and so forth. And this graphic also shows you the balances, but it shows you the loss rates. And you can see here that the portfolio division has the highest loss rate. For some reason, the commercial lending division is doing pretty well from a loss perspective, even though it has a large portfolio. And the retail has a high loss rate, but a small portfolio. Yeah. Now.
Hey, Dilip, this is Paul. May I run a quick question? Or maybe clarification.
Go ahead.
Yeah. So you have a risk engine that the numbers, the economic indicator numbers on the top left are the inputs to that engine, and you also have a portfolio that's been aggregated as input to the engine. And what happens is your engine then it outputs numbers, which are the numbers on the second column of charts and the third column of charts. Is that right?
That's correct. Yes.
Yeah. And so what you've done here is taken one single view of one of those scenarios, and they are able to see almost a 360-degree view of what that scenario looks like from your inputs to your engine to your outputs of both the income statement outputs and the portfolio outputs.
That's exactly right. So this would be almost a senior management dashboard where they could look at the outcomes of the stress test and analyze it at a very high level. So this is your 100,000-foot view, as it were.
Mm-hmm. Great.
So And then the last map here on the bottom left-hand side is shows the map of the United States, which is where this fictitious bank resides, and shows you where the big losses are. You can see that Southern California and up in the North Pacific Northwest are the two areas where this bank has got a lot of concentration of portfolios, and you can see the losses. Southern California is the biggest of them, but you have other areas of concentration as well. Okay? Now, the scenario that we've used here is a scenario where we took the stress scenario from the Federal Reserve and we added 50 basis points to unemployment. Okay, so it's the Federal Reserve stress, and then we said just take every unemployment rate for each of the 9 quarters and just add 0.5% to it. And that's what we see here. Now, if I worsen that, so I increase the unemployment not by 50 basis points, but by 100 basis points, you should see the capital ratios actually fall. And you can see them dropping a little bit. Let's go down to 130 basis points. You'll see that dropping even further. And the interesting thing you'll see as well is that the leverage ratio is dropping faster than the capital itself. So if I go back again to the 50, you'll see the leverage ratio is right above the red line, whereas at the 200 now, you'll see the leverage ratio is way below the red line, right? And this is interesting. It's certainly expected behavior where the leverage ratio will fall, and very soon you'll see the leverage ratio at some point will actually hit regulatory minimums. In the next tab, they'll show you that. So this is expected behavior as far as the stress tests go. Let's see what happens with GDP now. The GDP, as opposed to going up, the stressful scenario is the GDP is falling, is getting progressively worse. And in this case, I have a GDP of 100 basis points below, and the capital numbers sit where they are. Now, what happens when you do 200? I see something interesting here, and I'll do it again just so everybody can see. I see 100 here, and then watch what happens when you get to 200. The capital actually goes up. What we would expect is if GDP gets worse, we would expect the capital to fall further, and this is obviously counterintuitive, and this now gets into some of the challenge processes we talked about earlier. As a senior manager in a bank, I would look at this and go, well, that doesn't make sense at all. Why is my capital going up in a worse GDP situation? Explain that to me. Okay? So let's try to do that in this app. To do that, the first step would be to go into the financials. Actually, I'll move into, let's go to the financials. That's a good one. So this financial screen shows the net income. It shows the various scenarios as well. And what this view does is it allows us to compare multiple scenarios at any given time. But since we are we're interested in the GDP scenarios, I'm going to select the 3 GDP scenarios. And what you see right away is that the net income, which in a GDP that's 100 basis points situation, is a negative $2.2 billion. When you get to the negative 300 basis points, you can see it is only a loss of $1.7 billion. So you're going from a loss of $2.2 billion to $1.7 billion, which doesn't at all make sense. You would expect the loss to increase over a situation where GDP is falling so much, and we need to find out why. This screen, we've also set it up so that you can actually just look at the unemployment rate and the GDP, for example. And so you've got a view where we can show you, the moves in GDP. You'll see the one situation is at 25 basis points, and then there's a negative 1.75 and 2.75. That itself is probably an indicator right there of a negative GDP, which doesn't quite make sense. So perhaps the scenario itself wasn't well defined and well designed, so that is an indicator right there. But there may be other issues involved. The other one point I would make as a person analyzing this information is while GDP is falling, unemployment is staying flat at 10.64%. and that doesn't make sense. As the economy gets worse and GDP drops, you'd expect unemployment to actually skyrocket, and maybe that's a reason for this. So one question I would have is my scenario design appropriate, or does that need to change? Okay? But let's look at whether some of the models that are part of this whole process need to be addressed as well. And in this, we can go to the statement view. This basically shows the financial statement. It's a bunch of numbers, not at all terribly interesting, but this can actually help us think through where the problems are. So let me go to the income statement, and if I move to the bottom, I see the loss numbers here, the $2.2 billion loss coming down to the $1.7 billion loss, and that number is consistent with what I'm seeing in the graph. But let's go figure out what numbers are in fact counterintuitive. The first culprit would be looking at the actual credit portfolios and seeing whether their losses are lower or higher in different scenarios. I look at the total, and the loss here is $3.14 billion. The loss on the GDP, on the worst scenario, the GDP minus 300, is $3.141 billion. It's slightly higher, which is quite intuitive. You'd expect that to be the case. So let's go look at income aspects. A bank typically has interest income coming from loans it makes, as well as fee income coming from services it provides. The interest income on, you'd expect the interest income to drop, or you'd expect income overall to drop in a stressful scenario. And if I look at mortgages, it starts off at $681 million and goes down to $679 million, which again is quite intuitive. You'd expect that number to drop. But if I look at second lien mortgages, I go from $500 million to $524 million. That doesn't make sense. Or it may make sense, but it's certainly counterintuitive, and that bears some further analysis. We can't do the analysis right here necessarily, but it'll have to go back to the model owners and understand the theory behind the model, talk to the business involved with making second lien mortgage extensions, and understand whether, in fact, there is a good reason to believe that in a stressful situation, the interest income from second lien mortgages could grow. I mean, you could certainly come up with arguments to suggest that that is in fact correct, but those need to be investigated. Likewise, you'll see in credit cards it goes from $405 to $440 million. Again, this is a situation where potentially the numbers could make sense. You could anticipate that people are going to hold on to their credit card balances more. They may not be able to pay down their credit cards, which would lead to increased income. But those are all things that need to be analyzed further. And the other interesting aspect when you look here is the other assets. The income there goes very significantly up from $250 million to $400 odd million, increase of something like $158 million. Again, that needs to be analyzed. You can do that right here by looking at the balance sheet, and you'll see the other asset balances actually go down from 462 to 376 billion. And that doesn't make sense, because what that's saying is that the interest rates on other assets is skyrocketing, and that is completely counterintuitive. That doesn't make sense at all, and it tells me that the interest rate model is not behaving correctly. So this is all part of the challenge process that I was talking about. Another view of income can be looked at here. Again, the same sort of setup here, but if I look at the first lien mortgages, you'll see that the income is dropping very gradually and very slightly across the various scenarios. So your initial scenario has got 681 million, as we saw, down to it should be 679. But if you look at the second lien or the credit cards, you can see how the income is increasing, which is again counterintuitive. The other view of this is to look at the fee income, the kinds of fees that banks generate, and there again you see some counterintuitive behavior. If you look at deposit fees, they actually fall, which does make sense. People will typically withdraw deposits and so forth. But if you look at the commercial fees, it goes up pretty significantly, and that is again another area that would bear some analysis. Okay. Now, what I wanted to do in the remaining few minutes that we have here to talk about the demo is to drill down into a single model. One of the things that we talked about earlier on was to do with the challenge process, and a key component of the challenge process is to take the risk models that are being used in stress testing and challenge each one individually. And model governance is a very big topic in stress testing, and one of the aspects is for management to think about whether the model in fact is behaving correctly. This is actually a lot harder than it sounds because models have a lot of economic theory in them, they have a lot of statistics in them, and they sometimes have behavior that on the surface of it sounds counterintuitive, but in fact on analysis makes complete sense. So analytics is actually quite helpful in allowing management as well as people in the business to think about whether models are behaving correctly based on the data that have been output. The model we are showing here as an example is a model for commercial real estate, and the way it works is the stress test impacts things like the cost of the price of office space or the price of a warehouse space. As you get into significant stresses and the economy deteriorates, you would expect that the space for warehousing is not going to be as much in demand, and so the prices for warehouses would fall, which means the owners of those warehouses may not make as much money, and at some point they would default, which would then lead to a loss to a bank. That's how the real structure of the model would work in this particular case. And all those defaults are added up over time. So what this shows you is the losses by scenario, the cumulative loss over a 9-quarter period, and then the individual losses by buckets. The loan to value is an important metric. That's what LTV stands for, and you can see that the high loan to value, the greater than 80%, has the biggest losses. But interestingly enough, low loan to value loans also have a significant loss, and that bears some further analysis. It's counterintuitive that you have a very safe loan and that has a significant loss, but it's not impossible. There are scenarios and situations you could think of where that would lead to that would be appropriate. So it just needs more analysis on the model itself. Okay. The final panel that we wanted to show you was to drill down into the commercial real estate model and begin to really understand how the model works. As I mentioned a moment ago, the model it works by looking at indexes for various prices of commercial real estate. So we have here hospitality that has to do with hotels. You'd expect that hotels would start doing very badly in a situation of severe economic stress, and therefore they would default, and we should expect to see that. We should see industrial property go down. The multifamily loans have difficulties as people can't manage to pay their rent or indeed mortgages. Office space and retail as well, as retailers especially as retail firms go bankrupt. Retail space will get opened up in shopping malls and so forth. That would lead to the shopping malls themselves having difficulty, and these loans on shopping malls then getting into default. What you see here is the various pricing indexes, but really to do that effectively, one needs to look at a single scenario. I'm trying to find a scenario that actually has,
5,007, I believe. Yeah, one of those. Yeah.
There you go.
And then
So,
make sure you choose one of the property types as well.
Exactly. So
yeah.
You'll see here these numbers don't make sense. There's 300,000, and these are all in dollars. and surely office space doesn't cost $300,000 a square foot, but if I hit that, you'll see the office space costs $250 a square foot or a little shy of that, and it's falling. And this breaks it out by market. So in Phoenix, office space is actually at a premium, whereas if you get down to the Bay Area, I think it is, you're seeing that the office space is much less valuable in that area. So you can see though that the curves are behaving properly. They're actually going down pretty substantially, which is all what you might expect. Okay. The other aspect I wanted to show you was the average index by market, and what we have shown here is a radar chart that lays out the various markets, and you can see from here which market is doing better than the other. Just what we talked about earlier, but it's much easier to visualize here. The Midwest and the RRW regions are much less valuable, if you like, in terms of office space than Phoenix and Southern California, even in the case of a stress situation, which might lead bank management to make decisions about where they expand their business. They might say, well, if Phoenix is doing so well even in stresses, maybe we should be building our business in Phoenix versus going out to the Midwest, right? Another interesting thing we noticed in the data was if you hit industrial, you'll see that only Southern California shows up. We haven't, frankly, looked at the data to see whether this is because you only have Southern California industrial loans. That may be possible, but there's some analysis. Alternatively, the model might actually not be working correctly, and it might have zero values for industrial loans in the other regions, which is probably more likely. And that would mean that the model is not working correctly, and so we have to go back and look at the model some more. So again, this gets back to the model challenge process and being able to effectively understand the depth of the model itself. So with that, and we have a little more than 5 minutes remaining, I'm going to close off the demo itself. As I mentioned earlier, please do ask any questions that you have, and I'm going to go back to the WebEx. Paul, I need your assistance in doing that. I'm not sure how I do that.
I think you did it. So you can just pass me the ball.
Thank you.
Perfect.
Okay.
Yep. So you see the next slide? Yep.
Yeah, I do see it. Thank you. So before I pass it back to Paul, I just wanted to mention that there is a handbook out. So this is a little bit of a shameless plug because I'm one of the editors of the handbook, but there are a number of leading figures in risk and data that have written the handbook, and it's been recently published. It has a number of interesting topics on data, specifically a very insightful chapter on visualization that some of you may find interesting. I thought that would be useful to mention in the call. Paul, with that, I'll turn it back to you.
So just to be clear, the next version of this handbook will have Qlik view charts from your application that you built. Is that right?
That's the goal, yes.
All right. Great. I'm going to move forward on the slides, and we're going to enter the Q&A. We got a lot of great questions in, and we'll try to cover some of them. I would like to cover one of them is for Dilip, and it's how is visualization helping in this compliance process, in the actual process of complying with the regulatory requirements?
Yeah, that's a very good question. I think I mentioned earlier that banks have historically really not used visualization a whole lot because of the tremendous challenges in getting the stress test done in the first place, pulling the data together, running the models, and so forth. So that has not been a focus. But increasingly, regulators are beginning to ask very insightful and deep questions about the performance of the stress test. Very much like we asked in the demo, regulators are beginning to ask questions about whether the scenarios were properly designed? Did the scenarios really represent the kinds of challenges that a particular bank may have, and also whether the models behaved appropriately? So in that process, visualization can actually be very, very helpful, both in terms of being able to allow bank senior management to talk effectively to regulators. A picture is worth 1,000 words, and we see that quite often. But also for bank management to actually do a preview of their regulatory conversations themselves and ask these questions while the stress test is going on, so by the time it's done, they have a pretty good view of the answers. And being able to bring this huge mass of data together in a single environment where one can just look at pictures and come up with insights is very, very powerful, given the disparity of the stress test and the various very specific details that one needs to go into.
Great answer, and I would add that I see in the market, I get the privilege to actually see what our customers are doing with the software, and I actually see in the market many examples of bringing your portfolio into QlikView, and along the way, as it's being brought in, assigning regulatory capital such as Basel II capital, and then bringing that portfolio in and assigning another logic to it, and within QlikView, assigning Basel III capital, and exploring the differences between Basel II and Basel III side by side can be very powerful, because you're able to get that instant answer as to what's causing the variation in capital between the two regulations. And I've seen customers actually take it one further, where they've actually taken the income associated with that portfolio and calculated a return on regulatory capital calculation, which is very powerful. So not only is this helping in the compliance process, because you're able to understand what the compliance means, but you're actually now able to, it becomes a powerful management tool of the bank itself. So a lot of good questions coming in, and I'm going to try to keep on going here. We got 2 minutes left, but I think we'll go over a little. How long did it take to build this particular QlikView application, and can you describe that process to us?
Yeah, sure. As I mentioned, I am a QlikView neophyte. I honestly, I think I'd heard about QlikView before, but I didn't know what it was about, I don't know, 4 to 6 weeks ago. So that's when we really started working on this app. Maybe less than that, actually, probably a couple of weeks ago when we really got into the app. I think the initial prototype that we pulled together was probably in the space of a couple of hours, 2 or 3 hours, I would say. And then based on that prototype, we built on it. I have to confess for everybody on the phone that we were tweaking the app until maybe an hour ago, and we actually built a couple of the last panels that you saw on the CRE not 2 hours ago. So I guess the bottom line is I found it very easy to pull together. The challenge in this whole process, quite honestly, is not the building of the visualization app. And I see a question here that I think I will address at the same time as this conversation about what it took to integrate the data. Integrating the data takes a long time. That is something that we worked on for, I'd say, 2 or 3 months in pulling all this data together and then putting models on. The models that we used, I think that one of the questions is about whether something like R was used, and that's correct. The models that we've used involve a number of technologies, and the system that we have can take different technologies, including R, SAS, Visual Basic, Visual C++. I mean, any technology can be used, and we integrate all of that into a database. And then what happens is QlikView sits on top of that database and does the visualization from there. So that's the overall technology stack that we've been using. So that's I thought a very good question that we should address.
Yep, it's great. It's a great question. I would add that on the question about integrating with other engines, risk engines. This particular application, as you mentioned, is a visualization over the top of your stress testing process, and actually become part of the process itself now. But we have customers in the industry. We see three things happening in the industry. One is where you actually do what you've done and access the model output and the model inputs actually through the connection string and get the data source that exists. But we also have examples where customers actually are integrating with the risk engines themselves, but by using QlikView and sending from QlikView a statement to R or SAS or other risk engines, and then having the data returned back to QlikView in an automated fashion. That is possible, and there are examples of that out on the web you can find. And the third piece is something that is very exciting. The calculation engine in QlikView is very, very powerful. And in many cases, we find our customers actually offloading some of the calculations where it makes sense. And realizing that you have to be really careful about this and that statement, but we do see our customers doing it. They're offloading some of the calculations and handling them inside of QlikView, and that's very exciting.
I just said that we have actually used all three techniques in this app, right? So on the chart of accounts piece of it, we didn't have it in the original app, and we pulled that together over the past 2 weeks just by and the financial statement piece for the folks on the phone, which I showed you where you looked at actually the financial statement results as a whole table of numbers that had certain data that we had to pull from outside the database, and we did that pretty easily. And some calculations like averages and those sorts of things are also embedded in the app that didn't exist in the underlying database.
Great. Thanks for that clarification. I think we're running out of time. Is there anything you want to throw in? Any other questions you want to hit that you think are important, Dilip, before I close it up?
No, I think we covered everything in here. I'll just add that our contact information is on or was on the slide a moment ago. It's back on now, and I'd encourage anybody who has further questions and has a further interest to contact either Paul or myself, and we'd be happy to answer further questions.
Great. Thank you very much, Dilip, and thank you everyone for joining our webinar today. It was a pleasure to hold it, and thanks for your time.
Great. Thank you everybody for joining to conclude today's webinar. Tomorrow I will be sending out a recording link to all participants, so keep an eye out for that. As a reminder, for more information, we welcome you to visit our website, qlik.com, where you can find white papers, case studies, demos, and a free download of our personal edition. Thank you again for joining, and have a wonderful day.